Okay, good afternoon, everybody. Let's go ahead and get started. Let me know if you guys can hear my audio and see my screen in the chat box. Just give me a little Y or a yes there, just to let me know that it is indeed working. Hope everybody's having a fantastic afternoon. Hopefully your Friday's been going well. Happy Good Friday, everybody. We had a lot of great trades last night, a lot of great trades this week. We got to recap those this morning in the live trading webinar, which was super awesome. And I'm excited. Today, we're going to talk a lot about risk management and how you can manage your trades correctly. I'm going to show you some models that you can use to manage your trades. And I really, more than anything, just want to give you kind of a just an eye-opening experience. I want you to see how risk management can change how you trade going forward, right? And how these models can help you understand what is required to be a profitable trader. So that's kind of what I wanted to do today. Also want to give a shout out to everybody in the recording and those watching this on YouTube. If you have questions on YouTube, feel free to put those questions in the comment section down below, and I will get back to those as soon as I can. Also, for those of you that are interested in the live trading and you want to come to these live trading rooms where I trade live with my clients and we take these types of trades, there is a link in the description down below where you can go ahead and start a 14-day free trial where you can come to these classes and start taking some of these trades. But without further ado, let's go ahead and get started. As always, I need to remind you guys about the risks involved in this market. You can lose all or more than your initial investment if you're not careful. So please be aware of how many pips you're risking on each trade, in addition to how big your lot size is, and ultimately how that would affect your account if you were to lose money. So make sure that you're going through that process each and every time that you take a trade. All right, guys. So here's what I wanted to do. I wanted to, and I can go about this webinar any way we want to. So if you guys have questions specifically for me, feel free to ask those questions. And if you have questions that are totally different from the thing that I'm talking about today, feel free to ask those as well. I kind of designed this webinar for kind of the newbie trader who is looking to get started and needs a little bit of guidance. And so everybody's different. Maybe you need guidance on risk management like today, or maybe you need guidance on how to draw your trend lines or how to identify supply demand and structure. Whatever it is that you need help with, that's what this is for. So feel free to put those questions in the chat box, and it can totally be unrelated to what we're talking about. But let's go ahead and jump into this. So I have created a couple of scenarios here that I want to go over. These are risk management scenarios that will kind of, like I said, give you a little bit of an opportunity to kind of think about what type of trading style would work best going forward and how you can be profitable. So this first scenario is pretty straightforward. So in the market, when we're talking about risk management, there's two main things we talk about. One is your win-loss ratio, okay? What the win-loss ratio is, it just means however many trades you're taking, the sum of all your trades, how many of those were winners and how many of those ended up as losers. That's your win-loss ratio. And it is important that you have a good win-loss ratio. One second, I'm getting a call from Canada. Can I call you later? I'll just text them that. It's important to have a good win-loss ratio, but I am going to tell you that it is not everything. Your trading is also about your average win to average loss ratio, and that's number 2. Okay, this is very, very important. So the second thing, like I said, is your average win to average loss. And I would even argue that it might be the most important thing because it's the most difficult thing to accomplish, right? Anybody knows how to take a winning trade, and a lot of them. It's anybody, literally anybody can just go into the market and make a strategy that wins 90% of the time. And I really mean that. And I'm going to show you why. Literally anybody can do that. You can manipulate your trades in such a way that you build a strategy that wins 90% of the time. But the problem is that does not guarantee that you will be profitable. So a lot of new traders get excited when somebody comes up to them and says, hey, I have a 90% win rate. Like, come follow me because my trades are the best because I'm winning 90% of the time, when that honestly could be further from the truth, right? That's not the full story. In order to get the full story, you have to have that second component. Okay, I got this trader, I got this algorithm, I got this robot I want to buy, or whatever it is, I want to go into these signals. How do I determine if this is worth my time to take these trades? And it all comes down to both of those items. One, how often are you winning? And two, what's your win to average loss? So ideally, as a trader, our goal is to win on the winners. When we take a winning trade, that winner needs to be bigger than our losing trade, right? And our losing trade needs to be smaller than a winning trade. I used to trade the opposite of this, like especially when I was brand new to trading. I'd take a lot of trades. I'd throw in orders. I couldn't stand not being in the market. I always wanted to have trades, and I just wanted to be in the market all the time. And so I just throw trades in on almost any currency pair, on tons of currency pairs, and just trade, 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 trade. All right. And I couldn't stand losing either. So that was a big thing, is I really couldn't deal with the fact that I was going to lose money. And so one of the ways as a new trader I got around losing money was, oh, let me just not use a stop loss, right? That, that's not a good thing, right? Do not recommend that. But that's what I did, right? As a new trader, I was just like, okay, well, I hate hitting my stop loss. Just don't use one, which you'll learn pretty quick if you've ever done that, that's a terrible, absolutely terrible way to trade. The stop loss is there to protect your capital, and it's also to help you make more money. And I'm going to show you why the stop loss is so significant. And the tighter you can get away with a stop loss, the bigger the lot size you can have. And if you win that trade, that's where you get those huge gains, the types of wins that, buy a single car on a single trade, right? Like you can get really, really big wins. If you can play this correctly. Okay. I've had opportunities where an opportunity can, like I've taken trades where it's a 5-to-1, a 10-to-1 reward to risk ratio, and I will you can make thousands and thousands of dollars on that trade. But I've also had it the opposite, where if I trade that same strategy, that same setup, and I do a 1-to-1 reward to risk ratio and I win, I'm not going to make nearly as much. So that's why it's so important to kind of cut your stop loss if you can. And we need to narrow down the best entry possible so that we can get that out of the market. Okay, so with this scenario here, it's pretty simple. Like if you take 100 trades and you win 50% of the time at a 1-to-1, a 1-to-1 could be like a 10 pip stop loss, 10 pip target, or a 50 pip stop loss and a 50 pips take profit. That's 1-to-1. And if you win half of those trades, you're at break even. So you're just kind of spinning your wheels, and really you're kind of backwards because you spent all this time taking those trades and you spent money on spread and commissions. So in reality, that's actually a losing strategy just to break even, right? You need to do better than that. We need to do better than that, right? So let's move on to this next scenario. So scenario 2 is a little bit better, right? Scenario 2 is a 1-to-2 risk to reward ratio. Okay, I always get this backwards. I've always kind of, when I first started trading, the company I used to work for, we'd call it reward to risk ratio. And I think the standard in the industry, though, is risk to reward. So I need to kind of train my mind to get back to that. But it's risk to reward ratio. And so this is a 1-to-2. So an example of this would be having a trading strategy that generally has a 10 pip stop loss and a 20 pip target. That's a 1-to-2. Another example would be maybe a 100 pip stop loss and a 200 pip target. That's a 1-to-2. All right. And if you were to take 100 trades with this strategy or model, and you won half of your trades, you would actually be pretty profitable, right? Just at a 50% win rate. So you're only winning 50% of the time, but you're winning 50% of the time, but you're profitable. So what this works out to be is if you won half of your trades at 20 pips a piece, you would make 1,000 pips, and then you would lose from the losing trades, the other 50%, you'd lose 500, and you would also net 500 pips, which is great. That's a profitable strategy and it's worth trading. I think there's better strategies, to be honest, and I'm going to show you some. I don't actually like to trade the 1 to 2 anymore. I try to go for more than that on most of the trades I take. Um, I mean, it's still worth it, I think, but yeah, 1 to 3 is kind of my sweet spot. And honestly, if I can try to squeeze out a 1 to 5, or even I've had a couple of trades this year, like 1 or 2 so far in 2023, where I've squeezed out a 1 to 10. So you can get those. And the 1 to 10s are awesome because if you can grab those, um, and you didn't have a lot of losses before you took that trade, that's like a 10% return, just like that. It's very quick. It's amazing, right? Okay. So with this strategy, you have a lot more wiggle room. Okay. With this risk management model, you only need to win 33% of your trades to be a profitable, or at least a break-even trader. Okay. It's still not where I would want everybody to be, but it's okay. Like you can definitely make money trading like this. Okay. 33% is great. So you can lose literally more than half of your trades and you can still be a profitable trader, which not a lot of traders could say. A lot of traders would say, you know, hey, I lose more than 50% of the time and I don't have a good RR ratio. Okay, so the next scenario I want to show you is this one. So scenario 3, which is a 1 to 3 RR. Okay, so it's a 1 risk, 3 reward ratio. Okay, so an example of this would be a 10 pip stop loss and a 30 pip target. And again, another example could be like if you're a longer term trader, you know, you have a 100 pip stop loss and a 300 pip target, something like that. This honestly to me is the golden ratio, because there are trades every day on every single currency pair. And I really mean that, on different time frames, that will offer a 1 to 3. And it does happen every day. Does it mean it's happening every second of the day? No, but you can find these opportunities. They are out there, and our job is to go find them. And to me, it is the golden ratio. From what I've been able to accomplish, and from all the people that I know that are pretty good at trading, they all follow a pretty similar model to this, because one, you have an abundance of trades you can take every day, um, where there's 1 to 3s pretty commonly. And two, it's an extremely profitable approach. Okay. Once you start getting, in my opinion, and I'm sure people, you can light up my comment section on YouTube, right? That's totally fine. But it is harder. And I think everyone has to admit this. It is harder to get a 1 to 4, a 1 to 5, 1 to 10. They are out there too. I'm not going to deny that. But hear me out on this. If you start going to 1 to 4, 1 to 5, 1 to 10, I've even seen people take 1 to 25s, right? Like it's crazy. I've seen they're amazing traders. The thing is, they don't show you all of the losers that led up to that point to get to that 1 to 25 or that 1 to 10. It does take a lot of losses, because if you're trying to get that 1 to 10, or that 1 to 25, there are out there. I am telling you that you can get these trades. But the problem is I've noticed in my risk management model, what ends up happening is I end up losing what would have been a fantastic 1 to 3. And I lost it because my stop loss was a little bit too tight. And I was trying to get a 1 to 10. And I missed out on a great trade. And I would have loved to make an extra 3% of my account, but I ended up losing it. So, and I don't know if that's a great idea. Just hear me out on this too. I've put a lot of thought into this. I've traded this so much. If you start trying to get like these 1 to 10s all the time, um, or even 1 to 5 and higher, your psychology really gets messed up, because you're trading, and you're constantly taking these losers, just so that you can eventually get your 1 to 10. Now, I will tell you, when you get that 1 to 10 day, oh boy, that's amazing. You're going to be sitting hot. You're going to be really happy. You're going to want to buy a plane trip to Cancun, right? You're going to be feeling really, really good. But all the days before that, you know, it's going to be really hard to have the motivation, and you're going to be tempted to want to change your strategy and make a lot of other mistakes. So I think the 1 to 3, in my opinion, is the gold ratio because it's the one that keeps you the most profitable, in my opinion, but it also lets you be a human, and it also gives you an abundance of trades that are pretty much available every day. Um, that's why I like the 1 to 3. Now you can argue me, you can tell me why, I'm light up my comment section on YouTube. You can do whatever you want. But those are my reasons why I stick to around the 1 to 3 mark. And it's a great way to trade. Okay. So 1 to 3 again is a 10, an example, 10 pip stop loss, 30 pip target. Um, if you were to take 100 trades and win half of these, you would have netted 1,500 pips in gross pip revenue, and you would have lost 500 pips total, and you would have had a net of 1,000 pips, which is just perfect. That's exactly what you want. And the other cool thing too is you still can afford many losers at this rate. You can lose 75% of your trades and still be at break even. Obviously, break even isn't our goal. We obviously want to be profitable. I had kind of an interesting month. So I was actually reviewing my March statistics. Um, I actually had, believe it or not, my win rate went down last month. So in March, I was looking at my statistics and I was winning about 47% of the time. So I was losing more than half of the trades that I took. Um, Granted, some of the trades I take, I close early before they lose because um, I don't want the trade to go to the stop loss. If I can stop the trade before it gets to the stop loss, sometimes I do that. So I have a lot of losers that are minimal, like they're less than 1/4% loss. So sometimes I do that if I don't like the trade that's lining up. But nonetheless, my win rate last month was like 47%. So I was below 50, but I still had a great month. It was a very profitable month. And lost more than half my trades. I mean, how many people can say that, right? And I think that's really telling to a system, right? And that's why I try to kind of get close to this type of risk management model because there's room for a lot of mistakes, right? Or if the market's just not doing what you would want it to do, or maybe it is just a crazy market, whatever it is, you're still profitable. And that's the whole point at the end of the month is that you're still making money. Now, some months, like I've had 70% win rates at this 1 to 3, and I feel like an absolute millionaire. Like, like, nobody can stop me. I'm untouchable. It feels like I've had months like that too. And so the market really giveth a lot when you subscribe to this model and it's a good month. But even on a slower month and you're losing more than half of your trades, you're still doing fine. And that's what I love about this model so much. Um, and yeah, even if let's say you had I don't know how this would happen. I guess it could happen, but let's say you had an absolutely horrific month and you actually lost less. Let's say you lost 80% of your trades and maybe only won 20. Yeah, you'd have a losing month, but it would be such a small losing month that it would almost not even touch the scale. It'd be such a small losing month. Your next month you would come back and be red hot, right? Okay, so this is what I'm not saying you have to do this. It is somewhat of a recommendation because I've had experience doing this and it's worked for me. I'm not saying it will work for everybody, but I really like this model. But you can also be very profitable with 1 to 2. I will be honest, I don't know very many traders that are extremely profitable at 1 to 1. So I know you can make money with 1 to 1 right here as long as you're winning over 50% of your trades, but I feel like when you're at 1 to 1 and you're in a market that's allowing you to do much better than that, why would you take 1 to 1 trades when you can allocate that capital to opportunities that are countless throughout the day at 1 to 2 and 1 to 3? I hope that kind of makes sense. Okay, now I want to show you this, and this is the death spiral of a trader. And I have seen this as a coach. I've seen this running my own company. And, I used to mentor at another company before this. And, in my own trading, I saw this. But through the years I've been doing this, This is the biggest problem, I would say, in terms of risk management to a new trader, and it's honestly fatal. I've seen so many people exit the market just entirely. They throw in the towel and never come back to trading because they do this right here. So scenario 4 is very, like, this is pretty much your typical trader right here. Okay. So, oops, I got this backwards. I want to do a, let me fix this real quick. I want to change this to a 3, 3 to 1. There we go. Okay, so a 3 to 1 is the exact opposite of what we just talked about. So it's a risk to reward. So you're risking 3 units of whatever you're risking versus 1 possible unit of reward. And it just blows my mind that people do this now. I mean, I used to do this, so I guess I can't blow my mind that much because I've been through this, I've experienced it, and I know how tempting it is, because it is tempting, especially if you're having a tough time trading and you know, you've had, you know, your psychology's messed up and you feel a little desperate. I know the temptation to want to do this. So I understand it, but I think when we look at the math and we really look at things closely, it's like, oh wow, I would never do such a thing, right? So this is just the opposite. You're risking 3 and you're hoping to get 1 in return. Now the temptation to do something like this is pretty high, and let's talk about why. So the temptation is this. Well, the target is so close, the temptation says, well, let's just go ahead and do it. Let's just take this trade because, um, you know, I'm probably going to hit your target, and you probably will. You're probably going to hit that target most of the time with that kind of a stop loss. And it really just depends on other market scenarios and situations, but you will probably hit that target a lot. Okay. And you'll end up having a over 50% win rate no matter which way you're buying or selling. You probably will get that. Okay. So you're going to win, you're going to be right most of the time. But the problem is you won't be profitable necessarily. Okay. So here's how this 1 to 3 works out. It's just the opposite of scenario 3. So you take 100 trades at 50%. So let's say you're winning half of your trades. This means you will net 500 pips in gross pip revenue, but you will lose a net of 1,500 pips. And that would mean a total net of minus 1,000 pips. Not good, right? This is how people leave the market altogether and never come back, is by doing this exact thing right here. You lose 1,000 pips, and that's not a small loss. This is like a serious situation, right? Okay, so in order to maintain profits with this type of situation, like if you subscribe to this model, you have to win 75% of the time just to break even. So you have to be pretty darn good at knowing which direction the market's going to go. And my thought is, well, if you're already pretty good at knowing where the market's going to go, you might as well let that trade ride a little bit and get some more profit, right? But we don't think about that. You know, we just think, I just got to get this win. I just need to get this little win here to end my Friday or end my weekend or whatever. I just got to get this little win. Okay. So yeah, you do have to win 75% of the time. And that doesn't even include your, that doesn't include commissions and spread fees. And maybe you have some swap fees in there, depending on how long you've held that trade. So you might even need to win like 80% of the time, we'll say, just to break even. And that is not making money. That is, you're not making anything. You're just losing, or hopefully breaking even. So a lot has to go right. Let's just put it that way. A lot has to go right with this to be profitable. But if you go with this last one right here, you have room for error. You can take confidence in trades. Like, hey, let's hold this trade over the weekend. Let's see what happens. I got house money on this. We're doing well, right? A lot can go wrong. I guess not a lot can go wrong, but if things went wrong with this scenario, you would be okay, right? And eventually the market and the universe is going to align with your strategy. And when it aligns, when you're subscribed to this model, that's when you just absolutely crush it and you're making money like right and left. And when you and let's say the universe departs and your strategy and your zen in the market is not quite lining up, you're kind of you've kind of built this like shield over yourself during that time. So you're shielded when things are not right with your system and the markets are not liking your system. You're shielded in some way. You're still, maybe you're losing money for that week or you're losing money for that couple of days, but you're kind of shielded over that. And then when the clouds depart and the right market condition for your system comes up and you're subscribed to this model, that's when the money printer comes out and just prints money and puts it on your kitchen counter, right? Like that's how it works. But it doesn't work this way. Everything has to go right, and you really, in order to make something like this work, this scenario 4, is you need, honestly, so I actually know a few people that have this type of model that works kind of, but it's on algorithms. So I know a couple of robots out there that are floating out there that have been able to make a system like this work. But they're uncanny accurate and they're only meant for small sips in the market. They take these little micro profits and they move on to the next trade. So it can be done, but I wouldn't say they're the most profitable systems I've ever seen. They're just little micro, how do you call it? They're high frequency algorithms and that go out and just take these little trades. But we're not like that. We're not built for that, right? And I don't think we could maintain a win-loss rate that's sufficient enough to cover the amount of exposure that 30 pips or that 3-to-1 reward to risk ratio is rendering, right? That's just it's not gonna cut, right? And I want to just share a quick thing. So I was at a trading summit. I think this was in 2016. Yeah, it was summer of 2016. I was presenting at a trading summit and I was waiting for my turn to present and I was standing at the back for the other, I was waiting for this other presenter to finish their presentation, and I was standing at the back of this conference room, and everyone has their laptop out, everyone's trading, they're all talking to each other, and I heard this one guy next to me. It was so funny, I'll never forget it. He said, and he was kind of like this, by the end of the conference, it was, almost a week long, everybody knew who this guy was. He was kind of a loudmouth. This guy, he was telling this person next to him, hey, he just said, hey, if you just have a 100 pip stop loss and a 2 pip take profit, you'll never lose because the stop loss is so far away. and I was like, wow, that's crazy. Good luck with that. And then the person next to him said, oh yeah, that makes sense. And I was like, no, that does not make sense. That does not make sense at all. But that's what's so tempting about it, is I've been there, I've done that. I've tried that multiple times. And I think sometimes you just have to try it. Maybe try it in a demo account and then just be like, yep, that doesn't work. I've tried it. Give it a try with some fake money. And yeah, just watch that account just fall apart, because it will. But yeah, so if you think about it, there's a lot of fallacies in that comment. If I have a 100 pip stop loss, I'll never hit it. It's so far away. If I have a 100 pip stop loss, well, you might as well just not even use a stop loss if that's your logic, because the whole point of a stop loss is to get you out. It is to protect you. It is to protect your capital, right? And I like to think of stop losses like this. So a lot of the times, well, think about this, like this is a business, right? I hope you treat trading like a business. I hope everybody watching this is treating your trading like a business, because it has to be, right? Plus, you'll get way more satisfaction about your trading if you actually take it in kind of like a more professional and mannered approach, if that's kind of your approach to trading, you're going to feel like, hey, like this is awesome. I can do this. I'm being a professional. I'm following my rules. This is great. Versus just that guy that just, clicks buttons on the keyboard and, takes the mouse and just clicks it. You're going to feel a lot more satisfaction at the end of the day when you're trading if you have that professional approach. But I was going to say this. So, I mean, how many people, if let's say you wanted to start a business and let's say you wanted to open up a burger joint on the corner down the street, before you make your first sell on your opening day and somebody walks in to buy that first burger and fry from you, how much money do you think you have spent on that business before that first customer comes in? Oh my gosh, right? Like an arm and a leg, another mortgage, a second, third mortgage on your house, right? Like it's going to cost everything just to get that first customer in, right? And so every business costs money, right? Anytime you want to make money, it costs money, right? You well know that saying, like it takes money to make money, right? It is pretty true. Now anyway, I don't need to go into all the details of that. But in trading, it does require losses to be very profitable. So when I was a lot younger into my trading experience, I was always infatuated by these no loss systems, or these systems that would, win 95% of their trades. And I would go on YouTube and I'd go on Google and I would search, Forex trading strategy, win rate 90% or something like that. And then I'd go watch whoever's video on that. And I never had success with those systems because the ultimate fate of those systems is to, ultimately have a big loss after subsequent profits. So I actually, I saw this happen a lot with traders. So I'd coach traders. I remember at this other company I coached for, we had a lot of scalp trading systems. I do more swing trades now, which I really like. It's kind of where I do really well. And the problem I've seen with scalp systems is they often subscribe to this scenario. It's not all the time, but you can have these big losses and very small wins, right? And so I'd get these clients, they'd meet with me like once every 2 weeks. Okay, I'd meet with them, we'd have a Zoom call, and we'd have a lot of good conversation. And they'd email me a week later and say, "Yep, I've won every day this week. I never had a loss." And honestly, that comment kind of bothered me. Now, especially now, like if somebody emails me and says, "I haven't had a loss in 30 days," or "I haven't had a loss in several weeks," unless they don't trade very often, that comment would bother me. I know that sounds weird, but it would, because every good system allows for an expense, allows that pressure to be released through the loss, right? We're actually seeing breakdowns in the banking industry because they don't have that capability, right? I used to work for a couple of banks actually, and I won't go into all the details. I'm not allowed to say everything, but basically what banks do, especially the big ones who have a lot of extra capital, like the ones who had a lot of extra capital at the end of 2020 and 2021. I remember going to company meetings, and I remember this particular bank had a lot of extra money, and the executive said, "We have too much money on our balance sheet and we don't know what to do with it. So we need to get more loans out there. We need to spend more of this money." What happens is when the rates go up, the money supply gets sucked out. Okay. There's less money in the system. Okay. And so now these banks, what they have, especially the ones that are particularly in trouble right now, especially the one that just went down 2 weeks ago, that bank bought far too many bonds at high prices. So when you're buying bonds, when rates are down, bonds are up. And when bonds are down, rates are up. So right now, bonds have gone a lot lower. The bond prices are a lot lower than what they used to be. And that's great because, well, for somebody who has extra money, if you have extra money, it's actually not a bad time to buy bonds because the prices are low and the yields are high. So you can spend less money and still get a high return. Versus back in 2020 and 2021, these banks had a lot of extra money. They didn't know what to do with it, so they got top heavy in these way expensive bonds. They bought bonds at top prices and at a 2% yield. So they spent a lot of money and got a very low return. Now those same bonds are worth way less. They can't sell them at the market for what they were worth. So they bought all this stuff up here from the government, corporate bonds, government bonds. They bought them at top prices, and now they've gone down, and they don't even make as much as they make very little than the going rate today. The going rate today is much, much more. So the reason why I bring this up, I know I'm talking a lot about that, is because what happened to this one bank in San Francisco is they needed to raise capital to be able to pay deposits out to their withdrawal from their depositors. And they needed to service that. And they didn't have enough capital to do that. So what they did is they decided to sell these bonds that were worth more a couple of years ago. Now they're worth 75 cents on the dollar. And they were going to sell these at a loss, like a 25% loss, so that they could service their withdrawals, right? What's cool about what we do, and this is where I think we have an advantage over the bank, and I do want to make sure that everyone hears this out, because we do have an advantage over the bank. Everyone says, oh, the bank's taking all of our money, and maybe that's true, but at the same time, we have something that the banks just can't do, and it is the stop loss. That is your magic power that they don't have. All right, it really is. So use your magic power to your best ability, because they can't just get out of a multi-billion-dollar position at any price that they select to the tick. We can, because we don't trade as big as they do, and you can make thousands and thousands, hundreds of thousands, maybe even millions of dollars trading just with a simple plain stop loss. Like, here's my stop loss, let me get out. So because we can stop out and protect our capital, that is our advantage. So I hope one of the big takeaways in this webinar is that you view your stop loss as one of your greatest assets that you could possibly have, because it really is your asset. It's your magic power. It's literally, it's your advantage over the big banks who are competing against you, which they don't have, which is really amazing. It's another reason why liquidity works so well, if you think about it, because a lot of them, they don't really have stop losses, but they have longs and they have short positions on every single currency pair. And so when the market goes up, they liquidate, they sell some of their buys, they keep some of their sells. If the market goes up a little more, they maybe they'll add to some of their sell position, wait for it to come down. Okay, now we'll buy a little bit more, shave off some of that sell. That's kind of how they trade. So they're this big book of buys and sells, and they're just adding sells, buying, so they don't really use a stop loss. It's just wherever there's liquidity, they respond to said liquidity. Versus with us, we don't do a lot of hedging. We just take outright positions in the market where we see that opportunity. And if it doesn't work, we stop out and move on to the next opportunity, right? So that's our advantage. But it also could become a disadvantage if we don't use it correctly. And if you do something like this, scenario 4, where your stop loss is just so big, that's how you can lose a lot of money, right? All right, I'll take some questions if there are questions. Yeah, Lee, I see your comment from a little while ago. 2 pips won't even cover the spread usually. Yeah, exactly. Yeah. That guy, I remember that guy from, oh my gosh, that was like 7 or 8 years ago at that summit. I couldn't believe it. Like, wow, this guy uses a 100 pip stop loss and a 2 pip take profit. Yeah, he had a lot of winners. He had a lot of little winners. So, he'd go 90 trades in a row, hit 2 pips a piece, and then his next 8 or 10 trades he'd lose 100, and that's how you lose money, right? Well, cool, guys. So like I said, in recap here, this is the golden ratio. In my opinion, I talked about all the reasons why this is the golden ratio, 1 to 3, and or better if you can. But I wouldn't stress about getting something better than 1 to 3 if it's going to come at the cost of your win rate. So that's to me when it starts to break down, is if you go over 1 to 3 too often. Sometimes you just get a 1 to 10, 1 to 5, and it just falls in your lap, and you should take it when it comes. But I think this is the ratio that you want right here. All right, guys, I'm going to go ahead and wrap up. I really appreciate your attendance today. Thank you for coming. For those of you on YouTube watching this, feel free to click some of the links below. I do offer some free signals that you can take advantage of. If you want to take my premium signals where I post all of my trades, and or you want to come to these live trading sessions in real time where I trade in my account, make sure you click that link below where it says 14-day free trial, and you can go ahead and begin that and start trading with us. Thanks so much, guys. Have a fantastic weekend and Easter, and we'll see you in our next webinar.